Welcome back, navigators. In this video, we're diving deep into the world of fundamental analysis, unlocking the keys to evaluating a company's financial health and paving the way for your own financial success. Have you ever wondered how to evaluate a company's financial health? Well, there's a well-established method to do just that, and it's called fundamental analysis. Now, at first glance, fundamental analysis might seem like a complex beast, but let's break it down into simpler terms. Essentially, fundamental analysis is a way to examine the intrinsic value of a company by analyzing various factors such as its financial statements, market position, and overall economic conditions. Imagine you're at a fruit market. You wouldn't just buy an apple because it's shiny on the outside. You'd also consider its weight, texture, and smell. You'd want to know if it's ripe, fresh, and worth your money. Similarly, fundamental analysis is about looking beyond the shiny exterior of a company, beyond its stock price, and digging deeper into its core, its financial health. Financial statements, for instance, are a company's report card. They give you a snapshot of a company's financial health, its earnings, assets, liabilities, and its cash flow. Analyzing these statements allows you to understand how the company is performing financially, whether it's profitable, and if it's likely to remain profitable in the future. Then there's the company's market position. Is it a leader in its industry? Does it have a competitive edge? These are important questions to consider because a company's market position can significantly impact its future profitability and growth, and finally, the overall economic conditions. The economy doesn't operate in a vacuum, and neither do companies. Broader economic factors such as interest rates, inflation, and GDP growth can greatly influence a company's performance. So understanding these factors is also crucial in fundamental analysis. In essence, fundamental analysis is like being a financial detective. It's about piecing together various bits of information to get a comprehensive picture of a company's financial health. It's a valuable tool that can help you make more informed and potentially more profitable investment decisions. Understanding the concept of fundamental analysis is the first step to making informed investment decisions. Diving into a company's financial statements can seem daunting, but it doesn't have to be. Imagine you've just entered a grand library. Each book represents a company's financial statement, holding the secrets of its financial health. Let's pull out three key books, the balance sheet, the income statement, and the cash flow statement, and examine what each reveals. First, we have the balance sheet. A bit like a company's photograph at a specific point in time. It presents a company's assets, liabilities, and shareholders' equity. Assets, everything a company owns, are balanced against the sum of its liabilities, what it owes, and its shareholders' equity, the net assets belonging to the owners. A strong balance sheet generally has more assets than liabilities, showcasing the company's financial resilience. Next, let's open the income statement, which is more like a video, showing us a company's performance over a period of time. It details the company's revenue, costs, and expenses, leading us to its net profit or loss. A consistently profitable income statement can indicate a company's ability to generate earnings, a key consideration for investors. Finally, the cash flow statement, a bit like a company's heartbeat. It shows how cash moves in and out of the business, divided into three sections: operations, investing, and financing. Positive cash flow from operations is a strong sign, as it means the company is generating enough cash from its core business. Meanwhile, cash flows from investing and financing give insight into a company's investment activities and how it raises and repays capital. Together, these three statements intertwine to paint a comprehensive picture of a company's financial health. By using ratios, you can compare companies with their peers or current position against past one. The balance sheet shows what a company owns and owes. The income statement reveals if it's profitable, and the cash flow statement indicates if it's generating cash. Like understanding the plot of a novel, interpreting these statements can take practice. But with time, you'll begin to see the story they tell about a company's financial well-being. And with this knowledge, you're one step closer to making more informed investment decisions. Beyond the numbers, a company's market position plays a crucial role in determining its financial health. Michael Porter's 5 forces, suppliers, customers, barriers to entry, substitute products or services, and competition, provide valuable insights into an industry's competitive landscape, providing companies with valuable data to develop strategies to enhance their competitive advantage. All of these provide for what Warren Buffett calls a moat. Understanding a company's market position is akin to understanding the lay of the land in which the company operates. It's about assessing who their competitors are, how much of the market they hold, and the potential for growth they possess. Let's break this down. Firstly, we must examine the competitive landscape. A company may have an impressive income statement, but if it's in a highly competitive market with aggressive rivals, it could face challenges that could impact its financial health. It's crucial to understand who the key players are, their strengths, weaknesses, and strategies. A company that manages to stand out in a crowded field, perhaps through a unique product or superior service, is one that shows promise. Next, let's talk about market share. This is the portion of the market controlled by the company. A company with a high market share is likely to have a strong brand, loyal customers, and a solid sales network. These are all indicators of a healthy financial position. However, it's important to consider whether the company's market share is growing or shrinking. A declining market share can be a red flag, suggesting issues such as increased competition or failure to meet customer needs. Lastly, we must consider growth potential. This refers to the company's prospects for expanding its business. Companies operating in growing markets have a greater chance of increasing their revenues and profits. Look for signs of innovation, new product development, and expansion into new markets. Remember, a company's financial health isn't just about the numbers on its balance sheet. It's also about the company's ability to compete and grow in its market. The competitive landscape, market share, and growth potential are all vital pieces of the puzzle. A strong market position can be a strong indicator of a company's financial health. And understanding these factors can help you make more informed investment decisions. Now let's venture into the wider world of economic factors, which can significantly influence a company's financial health. Take interest rates, for example. When rates are low, businesses often take advantage by borrowing more to expand operations. This can boost their profits and make them look like a more attractive investment. But when rates rise, those same loans can become burdens as higher interest costs are eating into profits. Then there's inflation. A company selling goods or services may find its costs rising along with inflation, eroding profit margins. If they can't pass these costs on to consumers, their bottom line could suffer. And let's not forget about economic growth. A booming economy can mean more consumers with money to spend, potentially leading to increased sales and profits for companies. But in a downturn, discretionary spending often takes a hit, which can hurt a company's revenues. Understanding the economic landscape can help you better assess the position of a company whose stock interests you, and will allow you to make more informed investment decisions. Fundamental analysis is more than just crunching numbers. It's about dissecting the very core of a company's financial standing, understanding its pulse, and predicting its future. We've journeyed through understanding financial statements, where we learned that balance sheets, income statements, and cash flow statements are the beating heart of a company's financial health. We ventured into evaluating a company's market position. We realized that a company's competitive standing, market share, and industry trends are vital indicators of its potential growth and profitability. We then navigated the complex waters of economic factors, acknowledging that the health of the economy at large, interest rates, and inflation can all significantly impact a company's financial future. With this understanding, we've built a robust toolkit for fundamental analysis. Armed with the knowledge of fundamental analysis, you are now better equipped to evaluate a company's financial health and make more informed investment decisions. That's all for today. Until next time, take good care of your finances, navigators, and don't forget to subscribe and share if you found any value.